Have you ever wondered why, despite extremely low interest rates, the economy still isn't recovering, stocks aren't rallying, and consumer spending remains sluggish, even after central banks have pumped massive liquidity into the system? This may not be just a normal economic slowdown. It could be a sign of a liquidity trap, a far more dangerous and tricky situation. So what exactly is a liquidity trap, and how should investors respond? Let's dive deeper. A liquidity trap occurs when interest rates are extremely low or near zero, yet people still refuse to spend or invest. Instead, everyone hoards cash out of fear that the economy will worsen, or because they see no attractive investment opportunities. As a result, traditional stimulus measures like rate cuts or money injections by central banks fail to revive the economy. Today, the term liquidity trap is often used more broadly to describe economic slowdowns, where people hoard cash in anticipation of negative events. Key features include central banks, like the Fed, slash interest rates to stimulate the economy. Yet, despite very low rates, people still prefer holding cash and avoid investing. Traditional monetary policy tools become ineffective. The main driver is fear and uncertainty about the future. Not just bonds, consumer spending also weakens significantly. Signs of a liquidity trap. Several warning signs can indicate that the economy is slipping into a liquidity trap. Extremely low interest rates, yet no economic recovery. Money supply increases, but spending and investment stay muted. Surging cash hoarding due to future uncertainty. Disinterest in low-yield bonds. Persistent low inflation or deflation. Falling consumer and business confidence. If many of these indicators occur simultaneously, it could signal a developing liquidity trap. However, if investors are still actively buying bonds, the situation might not yet qualify as a true liquidity trap. Why does a liquidity trap happen? Liquidity traps don't occur easily, but once they do, the symptoms are clear. Near zero interest rates, economic recession, falling confidence, rising saving rates, and a reluctance to spend even when liquidity is abundant. Common causes include deflation. Falling prices encourage people to delay purchases, expecting goods to get cheaper. Future uncertainty, fear of job loss, income loss, or recession. Lack of attractive investment opportunities. Stock markets stagnate, bond yields are unattractive. Normally, central banks can cut interest rates to stimulate growth, but in a liquidity trap, rates are already so low that further cuts have little to no effect. Is the US entering a liquidity trap? After COVID-19 in 2020 to 2021, the Fed cut rates to near zero and injected massive liquidity. At the time, it was not a liquidity trap because money flowed into stocks. Consumers kept spending. However, by 2025, the situation has started to shift. Interest rates remain high to combat inflation. Investors are growing cautious. Capital inflows are slowing down. If the Fed cuts rates this year but the market doesn't rebound, is it a liquidity trap? Not immediately. If the market remains sluggish after a rate cut, it indicates proximity to a liquidity trap, but not the confirmation. How should investors respond if a liquidity trap happens? If the economy slips into a liquidity trap, investors should stay calm and focus on long-term strategies rather than reacting to short-term volatility. Key tactics include prioritize high-quality stable assets, such as companies with strong balance sheets and consistent earnings. Diversify across multiple assets classes to mitigate market risks. Consider alternative assets, such as gold or income-generating real estate funds. Liquidity traps don't mean total economic collapse. They often reflect an adjustment phase where patience and discipline can create strong opportunities when the market recovers. While holding extra cash might seem safe, excessive cash hoarding risks missing out when better opportunities arise. Lastly, closely monitor government and central bank policies, as new stimulus measures can suddenly change prices. Staying informed gives you a critical edge. If you enjoyed this content, don't forget to like and subscribe to the channel so you won't miss out the next update. And before we go, feel free to leave a comment about what topics you'd like to more about. Until next time, take care and see you in the next video.